Hello, hello. So a very good afternoon again. So I'm 𝗍𝗰 from the global research analyst with the global fixed income team. And today we have the whole global fixed income team from Singapore today to explore how you can hunt for yields as central banks cut rates. I'll be your moderator for today. And on my right, we have Colin. And in the middle, we have Cyrus, portfolio manager and senior research analyst respectively with the global fixed income team. Before jumping straight in to the questions and also the topic, let me give a brief primer to the bonds market. So for 2024 itself, it was primarily decent for the fixed income markets, although you could say that the performance has been relatively mixed across the board. Undoubtedly, the best performer had been Asian high yield, the Asian high yield segment, which benefited from the overall improving sentiments from some of the newly introduced real estate policies in China itself, which allowed the whole segment to gain about 15% across the entire year. On the flip side, we have global investment grade, which suffered quite substantially owing to the longer duration aspects of the segment, plus on the fact that we have been seeing the longer tenor treasury yields rising across the year, even though just past last quarter, we have been seeing the central bank's benchmark rates coming down over a couple of times. So my first question to the panel will be, how do you think interest rates will be moving in 2025? And can you share with us your thoughts on the possible movement of the federal fund rates across the year?
Yeah, so I think in terms of Fed funds rates and where you'll be headed, I think overall, how we look at it is we look at what the Fed is thinking. So the Fed, as everyone knows, has two objectives: stable long-run inflation at 2% and full employment. Two objectives. So when we think about on interest rates, we also look at inflation and unemployment. So the first thing is on inflation. So you might have seen recent headlines that US inflation is down from last time. And depending on the time frame you look at, they're not wrong. So now inflation is around the 3% level, sometimes 2+%. And this is, of course, lower than maybe the 6, 7, 8% we were seeing just a few years back. But I think it's important to emphasize that the Fed doesn't just look at one single data point. They don't just look at the latest data point. Their objective is also on long-run inflation. And based on some common metrics that we can see on this chart, so we have two metrics here, we can see that actually your long-run inflation expectations remain very persistently above 2%. And in fact, they have been above 2% since many years ago, since the 2021 period. They've been above 2% and they have not been coming down to that 2% level so far. And it's actually not surprising because one of the main contributors so far has actually been housing inflation. So this is about 20% of the PCE inflation basket. And when we look at some leading indicators like your Zillow Rents Index and so on, we see rental rates growing at a slower pace, but still very much growing. And we also see other risks to inflation, like what we see with wage inflation in this pretty decent labor market as well. So I guess on the labor market, I think overall there's quite a number of metrics here, but overall the labor market remains pretty decent. So the left-hand chart shows unemployment rate. Of course, it's ticked up slightly in the past few months, as you can see on the chart, but overall it's very much in line with what we are seeing pre-COVID. Non-farm payrolls still growing at a very solid pace. Again, similar growth rate to what we are seeing pre-COVID as well. And if you look at the right-hand chart in terms of wage growth, I think wage growth is looking decent as well. The Atlanta Fed wage growth, you can see the first line you can see, it shows the nominal wage growth, pretty decent, 4+% still. And even if it's inflation adjusted, the real wages by the BLS, it's also pretty decent. It recently turned positive. So I think overall these all show that, labor market is still doing well, purchasing power of your consumers are still doing well. And considering this long-run inflation expectation still above 2%, labor market still remaining strong, I think the case for policy rates remaining higher for longer is still very strong at the moment.
Colin, you have anything to add to this?
Right, I think if you look back, while we think interest rates will stay high, central banks have started to ease monetary policy. We see that over the past few quarters, in fact. This includes cutting rates, loosening the monetary policy a little bit, letting bond buying expire. And as a result, one of the bigger change in the fixed income universe is that sovereign yield curve or treasury curves have started to normalize last year. So in 2023 and most part of 2024, the yield curve was largely inverted. So this happens as policymakers hike interest rates, driving the front end yield, which are more sensitive to rates, driving that higher. But at the same time, the back end of the yield curve falls as market participants becomes increasingly pessimistic about economic growth as well as inflation outlook. But having said that, policymakers have begun to cut rates last year, and this has in fact drove down short-term treasury yields, while at the same time longer-term treasury yields have moved up because inflation expectation remains persistent, remains strong. So all in all, what we saw over the past few months is that the curve has been steepening gradually. And right now, from the chart over here, you can see that we are at a mild steepening level. So overall, moving forward, I think that major sovereign curves will continue to normalize this year, but will likely be led by long-term yields moving higher. And this will present investors many different opportunities in the bond market.
I think the key has been mentioned by Colin. So we do see the normalization of yield curve predominantly due to the rising of the longer end treasury yields, while concurrently we are looking at the fall of short-end borrowing, short ends with the recent rate cuts since September last year. So for Colin himself, I wanted to ask you, so with the yield curve still largely inverted, what are your views on bond duration within a portfolio of an investor?
Right, maybe I'll take this. So we still like short duration bonds, I want to emphasize that, and I think that it deserves a place in your portfolio. So the reasons for that are fairly simple. Despite rate cuts, we think that short-term yields are still high as compared to history, so it's still at a level where we find compelling. In fact, it is much higher than what investors can really get over the past 2 decades. So for example, short-term corporate bonds are offering over 4% on an index level, as shown in this chart right here. But if you look at individual bonds, you can even find some on the 5% level as well. But really, if you look over the past 20 years, the 20-year average was not even 3%. So for investor now looking at short-term bonds, they are getting quite a good deal right now. So the next question we ask ourselves is, can this level of yields be sustained? And we think, yes, we believe that the Fed will remain cautious towards rate cuts this year, and we have seen them expressing themselves in December's meeting. And we do expect this stance to continue this year, and this should set the tone for other central banks, for them to stay cautious on inflation, for them to stay wary on inflation as the battle is not over. And as a result, we do think that interest rate cuts will be few this year. So as a result of fewer interest rate cuts than expected, we do think that short-term yields can be sustained, can remain elevated. And we also think it is crucial to look at how much you as an investor is compensated today for investing in long-duration bonds as compared to short-duration bonds. For example, if you look at the US Treasury curve today, we do not see enough yield pickup offered by higher yielding treasuries. For example, the 6 months the US Treasury yield stands at around 4.3% thereabout, as compared to the 10-year US Treasury yield of about 4.6%. And this investing in longer duration US Treasury or 10-year over the 6 months gives you a pickup of about 35 basis points. And we do think that this pickup of 35 basis points is insufficient to compensate you for the extra duration risk. As if you look at the drop in price from our estimation, we believe that if the 10-year Treasury yields were to rise by about 5 basis points, we will find that the 30 to 35 basis point of yield pickup will be eroded away from investing in the long term over the short term bond. And as a result, to summarize why we like short duration bonds right now, it is because yields are still attractive, especially compared to history. And secondly, longer duration bonds are not offering sufficient yield pickup.
If that is the case, so given all the concerns that we have for the long duration bonds currently, so my question for Cyrus, maybe you can chip in for this. Where would you suggest investors to potentially add in long duration bonds to the portfolio?
So I think Yeah, Colin talked a lot about how short duration bonds are very attractive, and I absolutely agree with that. But I think overall, if you're looking at where you want to put your duration positioning, I think the most important thing, the most important takeaway for today actually, for me, is to follow the yields or to follow the yield curve. So I'll just add this warning that long duration is not always the solution to rate cuts. So I think we saw quite a bit of that last year. Everyone was thinking, oh, there's going to be a lot of rate cuts, it's time to add duration. Well, the bad news is if you had added duration just in anticipation of rate cuts, you will likely have lost money. So these are 3 scenario analysis. If you had bought 1 month before the Fed meeting, 1 week before the Fed meeting, or right before the Fed meeting. So this Fed meeting refers to the 17th September meeting where they cut by 50 basis points. So that was the unexpected one. So just looking at the last row as an example, if you bought right before the Fed meeting, on the day of the Fed meeting itself, up to 31st December, you'll be down 6% in total returns. So that's like 3 months plus 6% down. And if you look at today's number, as of mid-January, you're looking at closer to 7% today. 7% in losses, by the way, in just 3 to 4 months. So I think overall, it's very tempting always to say, there's rate cuts coming, let's add on duration. But I think we have to note that you have to see what the yield curve looks like, what yields look like at the moment, and really be very cautious on long duration products, and be very selective actually on where you want to be investing in. Yep. So yeah, so overall, being selective, following the yields. So what does this mean? So what this means is that we shouldn't be focusing on whether there'll be exactly 0 cuts, 1 cut, 2 cuts. Markets maybe 1.4, 1.5 cuts. I think the exact number for most of us investors isn't like the most critical. What is important to us, once again, is to follow the yields, follow the yield curve. And this means that you really need to be comparing the yields for your short end, short maturity, versus the long maturity bonds to see which really makes more sense. So since last year, this is a chart from Colin just now. Yeah, we already saw quite a pronounced steepening of the curve. Previously, it was very deeply inverted. Now it's almost fully upward sloping. I'll say not yet fully, but almost upward sloping. Just a bit of an exception at the start. But I think with this pickup, it's still a bit too early to really go out and say, oh, we are positive on duration. As Colin mentioned just now, you're getting about 30, 40 basis points of pickup from the 6-month to 10-year. I think really at this point, it's not sufficient to go out and really be truly extremely positive on duration at the moment. So I guess on duration, yes, the recent steepening is good. It's actually expected for us. We have been calling this for the past few months, for the past few years as well. But no, it is not enough yet. We are waiting for more steepening. We are waiting for our long-end yields to go up by even more. And for that to happen, I think one level we are looking at is perhaps the 10-year USD closer to around the 5% level before we truly see more opportunities emerge on the longer end.
So agreeing with Cyrus on this point, so ultimately we are in the position of wanting investors to really benefit from this overall situation and position. And the timing could really be better in terms of what we think is a suitable time before making the move into longer ends or duration based on this current situation or what we see. So moving beyond duration, another aspects will be credit quality, with it being something that we focus rather heavily on. So for 2025, what would be your recommendations for investors, whether to keep to investment grade or to look at high yield or potentially a mix of both?
Right, maybe I'll take this. I think to answer that question, when we look back, we want to reiterate our preference for investment grade bonds. I know this chart, there's a lot of things going on, so I'll walk you guys through. So we like investment grade bonds in general, and this is a segment we continue to like for several reasons. Firstly, yields for investment grade bonds remains quite attractive. So if you can look at the chart on the left-hand side, you can see that investment grade bond yields remains high as compared to the past decade, even despite recent rate cuts. So this is unlike high-yield bonds where you can see that it's on the right, unlike high-yield bonds where yields are around the historical level, historical average level. So if we look at levels over the past 10 years, we find that IG bonds are yielding relatively higher against the historical average. And also at the same time, high-quality bonds usually offer lower yield than riskier bonds because there's a less need to compensate for that credit risk. But in today's climate, we do think that investors have the opportunity to pocket high-quality bonds at appealing yield, and we do think that that is a steal. So this leads me to my next point. So yields for high-yield bonds, the high-yield bond markets have fallen in general. And in fact, the extra yield on an investor gets for investing in high-yield bonds over investment-grade bonds on a market level is very low. So simply put, investors are not very well compensated for taking greater credit risk, which is why we do think that investment-grade bonds at this moment are offering greater value relatively. And lastly, we do think that current yields for investment-grade bonds provide investors with a very attractive entry level. So let me share why. Bond yields can often be a proxy for investment returns over a given time horizon. And the chart here shows that buying investment-grade corporate bonds at a higher yield has correlated with a stronger returns over time, over the next 5 years, in fact. So for example, with having a yield of 4.8%, which is what global investment-grade bonds are trading at on the market level, it has historically translated to an annualized return of about 5 to 7%. Over the next 5 years, in fact, on an annualized basis. So if you compare that to the MSCI AC World Index, to the Global Equity Index, over the past 5 years, on an annualized basis, they have delivered returns of between 7 to 8%. So we are not saying that this is the returns for investment-grade bonds are equity-like, but it certainly is high and is appealing to us. So this is what we think is a good return profile given current yield levels, particularly for longer-term investors. And by holding investment-grade bonds, investors may achieve stronger returns while riding out near-term market volatility. So my next point is that I want to quickly highlight the benefits of investment-grade bonds on a bigger level. So as portfolio managers, we do often think about the asset class not by itself, but rather by how it fits into your portfolio harmoniously. So for investors here, I believe many of you hold equity within the portfolio. And so this table here shows that investment-grade bonds have recorded low correlation against major equity indices over the past 15 years, even against your Straits Times Index, so STI, which I believe many of you are familiar with. So this is unlike high-yield bonds, which have demonstrated more of a equity-like correlation that are higher in the same period. So the takeaway here really is that having low correlation suggests that investment-grade bonds are suitable natural hedges against equities, which can bolster your portfolio's diversification and ultimately reduces portfolio risk.
Meanwhile, for Cyrus, what would you like to add on for this?
Yeah, so I think Colin talked a lot about investment-grade bonds. And I absolutely agree. I think on a broad market level, just broadly speaking, if I had to choose one over the other, I'll choose investment grade over high yield or junk bonds as well. But this doesn't mean you should, totally avoid high yield bonds. There are still opportunities out there, many good opportunities out there. And I think with careful selection, it can still fit in your portfolio. So careful selection meaning selecting the individual bonds, credits that are good for you, good for your portfolio, as well as, or perhaps on a slightly broader level, you could look at some sectors or geographies that could once again fit your portfolio as well. So I think we have talked about we usually publish our recommendations on our website. And looking into 2025, we have looked at quite a number of Asian geographies where we think the high yield bonds do make some sense, like Japan high yield, Australia high yield, India high yield, and so on. But of course, in the interest of time, perhaps I'll just talk about Japan high yield. Otherwise, we can go on for the next 20 minutes, 30 minutes. So Japan high yield, I think this is a segment that we have been positive on for some time. On the macro side, the macro environment in Japan is very good. You see an ongoing economic recovery in Japan, of course. And I think one of the biggest news over the past 2 to 3 years has been, this shift out of a deflationary environment. You're stuck in this deflation for like 10, 20 years in this lost decade or so. And now it's shifting out of it. You're finally seeing proper inflation, closer to 2% right now. And that's on the macro level. But on the bottom-up level, we're also seeing a pretty good story. So default risks today, I think, are looking pretty good. Companies nowadays have multiple avenues of financing nowadays, not just bond issuances, but they also have the equity financing route nowadays, considering that Japanese equity markets have also recovered quite a bit. And overall, I think on the Japan high yield as a broad market level, I think there are many good opportunities out there for you to consider, once again, being selective in this market. So I have two examples here. So the first example is Rakuten. So one example is the Rakuten 2027 bonds. This is BB rated, so within high yield territory. But what we like is actually its solid revenue and EBITDA growth in its recent earnings reports. And another thing we note is that even though, yes, it is a bit more levered than your typical investment grade company, we think it's very manageable. Overall, we think its cash flows are decent. And of course, once again, as we mentioned just now, there's this strong equity financing ability that Rakuten can benefit from, once again, lowering its probability of default as a whole. Now, a second name I have in mind is actually Nissan. So this is another sort of high-yield name, 2027 bonds. So actually, this is between the IG and high-yield rating, depending on which agency you are looking at. But I think the point of recommending Nissan is that we like its overall, I'll say, medium to long-term outlook for the company. So this company, Nissan, has instituted a 2030 transformation plan, amidst, of course, we see quite strong competition in the EV space, but we think that it's instituted quite a decent plan to improve its capacity, to update its product lineup, all while maintaining a pretty sufficient liquidity and good financing capability. So I guess the overall similarity between these two issuers is that generally their fundamentals look pretty good today. As you can see, earnings, revenue, all pretty good. And also, not just today, but in the longer term, in the future, we think that they have pretty good plans, not just for the company itself, but to also repay their bonds. So I think being selective is key here. There are many opportunities within Japan high-yield space, within the high-yield space, and we think that there are definitely some that you can take advantage of if you have a bit more risk appetite.
I think in a quick summary, we are in a great time where opportunities continue to be around us, be it in a high yield or be it in an investment grade space. So it's really about grabbing those opportunities at the right moment across the bond space that we have at the moment. So taking this opportunity to move slightly closer back to home, so back to the Sing dollar bond space, 2024 has worked out well to be what we were mostly expecting. The environment really pushed for a fair amount of issuers into the debt market, with 2024 being a record high level of issuances across the bond market for SGD. Even though interest rates weren't that low, but we do see new issuers coming into the market to raise funds for debt. Hobby Land, Sabana Industrial REIT, and also Toronto Dominion Bank. These are some of the names that issued their first SGD bonds last year. And as such, the shopping list for SGD bonds can be quite extensive. So for Colin and Cyrus, so in the SGD bond space right now, what are the opportunities for investors to actually look out for at this current moment?
Maybe I'll take this first and Colin can chime in later. So I think one segment you can really consider within the SGD bond space is, of course, these are all high quality names, investment grade rated, but I think we see quite a bit of opportunities within the tier 2 bank space, tier 2 bonds. So all these 5 bonds are tier 2 bank bonds. These 5 issuers have issued tier 2 bank bonds. You can see, for instance, that there's a range for the yield because there are actually quite a number of opportunities for each issuer itself. So you really have to, for this presentation, I can't really elaborate that much, but basically there's a lot of opportunities, not just 5. So yeah, I think overall we like these tier 2 bank bonds, and for these 5 banks, the highest yielding one is going to be BPCE bonds. So this is one of the new issuances that 𝗍𝗃 mentioned just now in terms of new to the SGD bond market. So they first issued their tier 2 bond last year, and they issued another one this year. And overall, we think the yields are pretty good. So the recent tier 2, which was issued maybe 1 to 2 weeks ago, was at 4.6%. And today, if you're looking at the indicative yields on the secondary market, you're seeing indicative yields of about 4.3% to 4.6%, which is, I would say, quite high within this space as well. Of course, on the next tier of yields, you have Commerzbank AG, that's in the 4th row. You can see that that's about 4.35 to 4.45% yield. But of course, the credit rating is going to be a bit lower. It's still investment grade by the BBB- rating. And after Commerzbank, I think we have other banks like your BNP Paribas, your Credit Agricole, as well as your HSBC. So these are higher investment grade, but the yields are still going to be pretty attractive at, the 4+% region. So I think in terms of if you're looking for something relatively safe, high quality bond opportunities, there are quite a number of options out there for you in the tier 2 bank bond space. From the 4-ish% level in BNP Paribas, Crédit Agricole, as well as HSBC, as well as the highest yielding right now, which is probably your BPC, which is closer to the 4.5 plus 4.6% range.
Right, maybe I'll add on to talk a little bit more on the non-financial bonds. I believe investors also are keen on both financial and non-financial bonds based on our conversations with them. And if you look at the higher yielding SGD bond space, you can see that there are lesser options as compared to, say, the US dollar or the Euro dollar bond space. But having said that, I want to make it clear that opportunities do exist, but bonds that are higher yielding, but has a stable credit profile is much lesser. So here are some names to consider from SBI Lifestyle, Thomson Medical Group, Olam, and Hobby Land. So for example, SBI Lifestyle's 2027 bond offers one of the highest yield in the Singapore dollar bond space. It is a consumer lifestyle group which houses renowned brands such as Maxi Cash, 𝗲𝘃𝗀𝘁, or even 𝗲𝗃𝘃𝗁. And Olam's 2026 bonds are also attractively priced, and it is a good short tenor options for investors. The group's earnings have remained quite resilient, and its credit profile have been relatively stable over time. Whereas if you look at the Thomson Medical Group's credit profile, it has in fact moderated by a little bit in 2024, but this is following the acquisition of a hospital, but we have anticipated this, and we believe that the company should see benefits from this acquisition moving forward. And we do expect credit metrics from Thomson Medical Group to improve over time. So broadly speaking, these bonds we recommend because they give generally above 4% yield, which is increasingly harder to find within the bond space, Sing dollar bond space right now, and they also have short years to maturity. And lastly, we think the issuer credit profile remains relatively stable.
Right, so taking this chance as well to show you the final slide, our consolidated list of recommendations across the bond funds through all the different market segments, and also the recommended bonds for what we see at the moment. Closing up today's session, what are your key fixed income takeaways for the investors here at the FSMOne Invest Expo 2025?
Okay, maybe I'll start first. I think my key takeaway for bonds is that, okay, so maybe last year, the theme for bonds was that income and yields are back. So I think the message from me this year is that income and yields are here to stay. So we are seeing quite a number of attractive yielding options out there. In the Sing dollar space, we talked about a bunch of them above 4%. And in the US dollar space, you can get them at 5+% for very solidly investment grade bonds. So if you're looking for something fairly safe, fairly low risk, to earn a pretty attractive level of income and use, I think bonds are going to be a pretty good option in the year ahead.
Right, just to add on what Cyrus says, income and yield are here to stay. Also, if you look back over the last few years, bonds as an asset class have had quite a challenging time, but they have gradually recovered, and in fact recovering strongly. And looking ahead, when we look at the headwinds holding back bonds, the bumps along the roads, they are declining, they are decreasing as we see the interest rate hikes are a thing in the past right now. And at the same time, bond yields remain higher and able to be sustained. So the whole investment case for bonds is that headwinds are declining, but yields are able to be sustained at a higher level, offering investors much more opportunity within this space.
Okay, so for me, I'm doing a shameless plug here. Do not forget about bond financing as part of your strategy for yield enhancement. With that, we have come to the end of the fixed income panel discussion, hunting for yields as central banks cut interest rates. See you around and feel free to catch us for any questions. Thank you.